Hello again from me, Louis Rossouw. I'm a portfolio manager at Adviceworx Private Client Securities, and I'd like to spend the next 10 minutes or so sharing ideas with you. I will discuss the COVID-19 pandemic and its impact on the global economy and investment markets. I will also explain how Adviceworx interprets the current investment climate and share our view on prospects for the rest of the year. The month's big international news was the withdrawal of American and NATO forces from Afghanistan, which triggered a rapid collapse of the Afghan military and government. This in turn caused a refugee crisis as Afghans who had cooperated with the Western forces desperately sought to escape the vengeance of the Taliban. Despite a massive airlift which evacuated more than 150,000 people, thousands of Westerners and anti-Taliban Afghans are now marooned and at the mercy of the Taliban government. As of the 31st of August, 218 million people had been infected with COVID-19 worldwide, and 4.5 million people had succumbed to the virus. The United States remained hardest hit, with over 40 million infections and more than 655,000 mortalities. India, Brazil, Russia, and France still make up the rest of the top five, and South Africa remains in 17th position in terms of the most recorded cases. By the end of August, 3.1 billion people, or 39.9% of the world's population, had received at least one dose of COVID-19 vaccine. 5.3 billion doses of vaccine had been administered, and the daily vaccination rate had reached 41 million. China, India, and the United States have administered the most doses. Around 2.1 billion people can now be regarded as fully vaccinated, with nearly half of them estimated to be Chinese. The two main challenges remain vaccine hesitancy, encouraged by disinformation in the developed world, which has enough vaccines, and the slow vaccination rate in the third world, which does not. Global economic growth showed signs of slowing down in August, with supply chains remaining under pressure as the Delta variant continued to trigger lockdowns. The many new jobs being created are being negated to an extent by the lack of requisite skills, and governments and central banks are running out of stimulus resources. There are still many reasons to believe that growth will remain robust for another year, though. A key shift is that the Eurozone looks set to replace the United States as the growth epicenter of the developed world. The US equity market remained resilient in August, with the S&P 500 reaching a new record for the 50th time this year. Mumbai Sensex was the best performing major index and the JSE's top 40 the worst. For the year to date and the past 12 months, the Sensex also led the way, with China's A50 bringing up the rear. Over 3 years, the Nasdaq is still comfortably in the lead, and the Hang Seng in Hong Kong the wooden spoonist. The cooling off of economic growth coincided with a sell-off on commodity markets. Coal and aluminium were the only notable exceptions, while the bottom fell out of the battery metals sector. Lithium, which until recently was the year's best performer, suffered a massive reverse. Coal is now firmly in the lead for the year to date, while platinum has fallen behind gold as the year's worst performer. Let us talk about the economic and investment outlook for the third quarter of 2021 now. The global economic recovery continues, but the continued evolution of new COVID variants threaten to derail it. Vaccination proceeds apace in the developed world, but its rollout is uneven in the third world. The US economy is booming to such an extent that inflation is becoming a problem. It is unclear at this stage whether higher inflation is a temporary or more persistent problem. If inflation is in fact here to stay, it will lead to higher interest rates and economic slowdown. The inflation conundrum poses a challenge to central bankers. Premature monetary tightening will dampen the economic recovery, while inaction could cause inflation to become systemic. Judging by the recent drop in bond yields, the market is expecting global growth to slow down in the coming months. This decline in yields provides support to the equity market, which has been becalmed of late. The prospect of rising US interest rates has resulted in a firmer US dollar, and capital is once again flowing back into US markets. Sadly, the biggest local news for the month of August was South Africa's ever-worsening unemployment figures. Out of 82 countries monitored by Bloomberg, ours is the highest rate. With 375,000 formal sector jobs lost in the second quarter, South Africa's overall unemployment rate is now 34.4%, or 44% if the expanded rate is applied. For under 24s, the rate reached 75%, and for under 34s, 50% if this measure is used. To add insult to injury, our population's dependency rate is over 52% overall and nearly 65% for under 19s, which means that unemployment is likely to get worse. More than 330,000 South Africans tested positive for COVID-19 during August, which brings the cumulative number to date to just under 2.8 million. 10,248 people succumbed to the virus during the month, which raised the death toll to date to 82,261. About 30% of the current active cases are in KwaZulu-Natal, while Gauteng remains hardest hit in terms of cumulative cases and deaths. Fortunately, our vaccination rate is picking up and all adults are now eligible. So far, nearly 13 million doses have been administered and more than 5 million people are now fully vaccinated. The recent sharp rise in inflation seems to have run out of steam, and the Reserve Bank is confident that better days lie ahead. Food inflation looks set to moderate, but a weaker rand could see fuel prices remaining a headache. Government seems to have lost its appetite for a state-run compulsory pension fund, and softer commodity prices are weighing on South Africa's trade surplus. The JSE endured a torrid month, dragged down by resources and Naspers. Financials were the standout sector, with consumer stocks like Shoprite also doing well. Prosus is now the preferred entry point into Tencent. Government bonds and the rand were both volatile, but ended the month only slightly lower. Foreign selling remains a fact of life on the JSE and the bond exchange. We remain concerned about the local economy's slow recovery, which has been hampered by lockdowns, the slow start to government's vaccination program, and renewed load shedding. The unrest in KwaZulu-Natal and Gauteng, followed by the cyber attacks on Transnet, added insult to injury. The OECD expects our GDP to only get back to its pre-pandemic levels in 2025, but at least inflation remains under control for now. Petrol and diesel prices will rise sharply in August, but at least Medupi is now operational. The commodity export boom will boost government's tax revenue, and South African Airways will henceforth hopefully be less of a drain on the fiscus. The Adviceworx asset allocation view can be summarized as follows. We remain overweight global equities because of the greater opportunity set they offer and our long-term concerns over the structural vulnerability of the rand. We are gradually adding to our local equity allocation and remain neutral on global property. We still avoid local property because of the uncertainty over the long-term health of the sector and hold no global bonds unless specifically mandated to do so. We are also maintaining our tactical overweight position in local bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make at least some sense of it. Should you have any further queries or questions, please don't hesitate to contact me or your Adviceworx financial advisor. All the best for the week ahead. Goodbye from me.